So we're back again, Matt Piepenburg and myself. Matt, there's certainly enough things to talk about, and we both expect that we could have some major happenings this autumn in this everything bubble. I've written about that we are in an illusion. Of course, if you have free money and create unlimited amounts, you get an illusion or many illusions. Yeah. And you've written about the same thing, where that nothing is real. So tell us a little bit about actually what you mean by nothing is real, Matt.
Yeah, there's a long list. We could go and spend hours on each topic. We could just start with 300 trillion, in global debt. Then you add on unfunded liabilities and derivatives exposure. We're talking about quadrillions in literally unpayable, unsustainable debt. And so that's an obvious unreal or surreal notion. The other thing that's just so unreal to me is, you've got GDP with negative growth rates. The Atlanta Fed has already cut its forecast on GDP in the US this year by 50%. You've got year-over-year inflation over 5.5%. You still have central bankers trying to pretend that this is a temporary, transitory inflation. You've got markets, despite recent volatility, engineered markets reaching, all-time highs, despite consumer sentiment reaching all-time lows. The disconnect between what's felt on Main Street and what's happening on the markets is extraordinary, unreal. And then, to top it all off, Egon, you've got 19 trillion in negative yielding sovereign bonds across the globe, from America across the Atlantic. So to the South Pacific, and remind people that a negative yielding sovereign bond technically is a defaulting bond. That also means that when adjusted for inflation, if you're buying Uncle Sam's treasuries or the Bank of Japan's or the European bonds, you're effectively guaranteed to lose money the moment you make the acquisition. So the combination of debt to feeble inflation discussions or excuses, to negative yielding treasuries, to all-time market highs against Main Street sentiment tanking is just unreal. And, again, each of those topics is worthy of its own session. But you'd also talked and written recently, Egon, I think it's worth bringing up again in this everything bubble. What really is value investing today? and how would you describe it in a world of SPACs and equities and even Labrador puppies in unbelievable price levels?
I've always believed in that value investing is buying something that's unloved and undervalued. And today the market doesn't agree with me at all, because they're just buying things that are overloved and overvalued. And this is why we get these, for example, these SPAC, special acquisition companies or blank check companies that are where basically you take a shell listed company and then you merge it with a private company and you create and raise money in order to buy other companies. I mean, this. And you create values which in the billions out of not out of nothing, but basically you inflate the values dramatically here. And again, that's nothing new. We talk about history all the time, but we've seen already in the 1720s in the South Sea bubble, they did exactly the same. They created a company to just make money, basically, and they told investors, we're going to make money when we'll buy something or do something with it. And so these things come back always over and over again in history. So this is not new, but it's new to today's investors, and they don't realize actually what's happening here, because this everything bubble is going to burst. You're looking at companies at 10 times sales today. I mean, that was again in the 2000s. I mean, or early to 99, 2000. I was involved with a company an e-commerce company that we actually sold at 10-ton sales, because I said we have to sell it because it's just overvalued and overloved again, and therefore you're never going to get these values again. And we were right. Nasdaq collapsed 80%, and the same with. A lot of stocks you can today buy Bitcoin, for example, is up 470,000 times since 2010. So you spend 10,000 in 2010 on Bitcoin, and you today would have whatever it is, 4 billion, I think. That's unbelievable. Yeah. So that's what we mean by the everything bubble. But it is, of course, Matt, a form and we have some graphs here to show also, and our viewers could look at companies trading at 10 times sales, I mean, which is at a maximum, and if you see that graph coming up here, I mean that's twice as much as it was in 2000, and it just goes up exponentially, and the same with margin debt. Margin debt is a sign of actually speculators putting more money in than ever. And that's again is gone up 3 times since 2009. So we're talking about inflation, Matt, and inflation is something that you again have written about, and that we both worry about a lot.
Yeah. Well, look, inflation has been a debate. It's becoming less of a debate. Even some of the Fed vice chairs and governors are backpedaling now, getting away from the transitory or temporary. I mean, again, remind people that Nixon said that the decoupling from the gold standard in 1971 would be temporary. Bernanke said that the QE1 of the post-2008 great financial crisis would be temporary. And now Powell is saying inflation will be transitory. Each one of those examples is just fork-ton fiction. And I think that's becoming more and more clear. But even if Powell wants to pretend that inflation is transitory, it looks like the Social Security Administration in the United States is disagreeing with him, because the cost of living adjustment for 2022, they're looking at a 6% cost of living adjustment or COLA adjustment. So apparently the Social Security Administration is foreseeing at least 6% inflation in 2022. And again, reminding folks that if you use just that measure of inflation of the cost of living adjustment against a 1.4% yielding treasury, you're losing 4.6%. It's a tax. It's a tax on the people. It's an additional tax, certainly on the more struggling middle class. It's just one more insult from the central bank all the way down to Main Street. There's the reality is, I wrote about, I call it Uncle Sam's bar tab. There's another thing that's fascinating that's ignored in the tweets and ignored in the financial press, is that the interest expense on U.S. public debt, national debt, Uncle Sam's bar tab, the interest expense alone on that is 111% of tax revenues coming in. And we're talking major capital gains on the new millionaire class on the NASDAQ and the Dow and the S&P. But even with those tax receipts coming in, it still isn't enough to even pay interest, not to mention principal, on Uncle Sam's bar tab. So of course, if Uncle Sam has a big bar tab, the last thing the central bank's going to want to do is make the interest rate or the yield on the bonds higher, to make that even more painful and more embarrassing. So again, it just means more forms of liquidity, whether that's the standard repo facility or whether that's QE by another name. There's going to be more liquidity and, of course, more currency debasement. And finally, I think the ultimate insult is when you talk about inflation and who's going to pay for these unloved U.S. treasuries. It's worth noting that in 2009, in the backstop of the great financial crisis, the U.S. dollar and Uncle Sam's IOUs were still considered safe landing spots. There was $500 billion of inflows in 2009 into the U.S. Treasury market. I think people need to be reminded, last year, at the height of the kind of COVID pandemic hysteria, when the markets took a huge dive in March, there were $500 billion of outflows out of the U.S. Treasury market. Not only were they not buying, they were selling. When you add that to a $700 billion current account deficit, who's going to pay for those treasuries? How it's going to be paid for? We know the answer is going to be artificial liquidity, more inflationary forces. So again, it's just simple math and hard reality. And again, these things are quantifiable and not just debatable. I think this brings to this whole idea of constant forms of liquidity under new names, standing, repo facilities, QE, QE1, QE4, stimulus, accommodation, whatever name you want to call it. It's a lot of semantics, a lot of be calm, carry on memes. We all know that there's some version of a reset coming. Again, there's going to have to be some kind of global and national restructuring of currencies and debts, and they'll call it under some name and they'll justify it by the pandemic. Although all of these things in place with debt and over our skis in debt nationally and globally was in place long before Wuhan. I want to get your thoughts, because you've written about this recently, Egon, on just what a reset would look like. Is it going to be a calm and orderly reset or a disorderly reset? You've talked to me about this for years. I'd love to get your thoughts on that again.
Yes, well, Matt, this is just an incredible situation. But again, we think it is we are unique in history, but we are not. It happens with regular intervals throughout history, and that's why no currencies ever survive, because currencies go to zero, as we will show later in the graph also. So well, who's going to pay the piper? I mean, that's really the question. Who's going to pay? Well, nobody, because there is no. You can't pay by, as you've been talking about, issuing new debt increasing the money supply and creating money and increasing bank lending, etc. So you can't. So the authorities are now desperate, or central banks are desperate around the world to come up with an alternative. And of course, that's why we're talking about central bank digital currencies. And as you know, I mean, that's every major central bank is talking about it. So we're likely to see that in the next, let's say, 5 years. But it's going to be everyone for himself, in my view. It's not going to be one central digital currency at all. But of course, that is just a way of avoiding the problem. So they're creating another type of fiat money now, totally electronic, which has other advantages. You can control the people. You can charge them taxes or penalties or fees or whatever you want, and turn off the money supply whenever you want them to stop spending. So that is quite a dangerous situation. I don't think it will last. I mean, this is just another way, as I said, of telling the people that the debt is gone. It's in a separate pile now. We don't need to worry about that. We have a new currency. But in my view, if they actually come up with that and a orderly reset, where they will try an orderly reset, that's not going to last. It's going to last a very short time, because the debt is still there, and the debt is still at a historically incredible level that you talked about, 300 trillion plus derivatives, as I've talked about, of at least $1.5 quadrillion. Wouldn't be surprised if it's up to $2 quadrillion now. And that means at some point they're all going to be worthless. And in my view, they're going to turn into debt. And because banks central banks have to support the commercial banks and buy these derivatives, which are worthless, and therefore there'll be more debt. There'll be could be $2 quadrillion debt. So that will lead to a collapse, a hyperinflationary collapse or implosion of the system, and that's, I think, the real reset. And of course, hyperinflation and normally in then a deflationary implosion of when everything comes down in value. So that's what, in my view, what we're going to go through in the next 5 plus years. Could be 10, but it could be very quick also. So that's going to be very rough for the world, Matt, and a lot of people are going to suffer. Nevertheless.
And as we've talked about, Egon, and we've all written about, it's the antidote to that, as these currencies fail into these debt implosions, the antidote is gold. And where gold is priced now, we'll throw a graph up there, where gold is priced now is extremely, talk about a good value investment. You couldn't get a better opportunity. As currencies lose more and more of their value, the price of that gold vis-a-vis those currencies is going to get higher, which brings me to my last question to you, Egon, because even though gold is a great value now relative to the broad money supply and where the price of gold is compared to 1971 or 2000, I've written and talked about in interviews recently about where I could see gold in 5 to 10 years, and whether it's 5,000, 4,000, 8,000 by the end of the decade. You and I have talked offline about that's almost a specious question or specious answer, in the sense that because you're still measuring gold versus a currency. And what is the value of that currency, whether it's dollars, kroners, Swiss francs, euros, etc. When people ask about the price projections or forecasting gold price, in a nutshell, Egon, how would you really try to address that question? Because it's a normal question, it's an important question, but at the end of the day, it's still measured by currencies that have no value.
I know, we all do that, and we look at gold totally differently. We look at it gold as wealth preservation, not as an investment and the value which you look at it on the screen on a daily basis. It's irrelevant, because when you have a wealth preservation investment, I call, for example, your family. That's the biggest asset that most of us have, and that's invaluable. But we don't measure it in money. And the same with your house. You shouldn't really measure your house in money either. You should buy a house that you can afford to pay for, and then that's a place to live and to place to enjoy life, not a place to think about as a trading asset, buy and sell. Of course, with house prices the way they've been going up in the last decade or 2 or 3, and then of course people use it as an ATM, taking money out all the time, or borrowing money, or swapping houses. But that's over history. House price has gone up by maybe 1% average, over the last hundreds and hundreds of years. So what we see now is, again, is an illusion. It's unreal. It's because of printed money. So therefore, coming out back to gold, you shouldn't measure gold in money terms. I should measure it in grams or ounces. But of course, most people like to see, how much is it going to go up, etc. It's irrelevant. You buy protection, you're buying insurance. You don't look at the value of your insurance. You look at actually, what does it do for me? It protects me against a potential catastrophic collapse of the financial system. Or if it's not that bad, it could protect me against an inflationary implosion of money. And therefore, and might say inflationary, implosion of the value, but that means that will be, hyperinflation, and gold will reflect that. If you have to measure gold in money, but that is what gold is protection. You don't think about it as a price, but I've said before, and I'll say again, gold could go to, I said that 10 years ago or more. Gold will go at least to 10,000 in today's money. That's not a forecast, but that's where it should be in my view. But we won't have today's money, so that's totally meaningless. Tell me what the dollar will be worth in purchasing power terms, in Big Macs or whatever, in 10 years time or 5 years time, and I'll tell you the price of gold. So don't think about gold, just think, buy gold for, and to protect yourself. And that's really what we're looking at. And so that's why, I always show this chart. Look at gold is undervalued and unloved today. It's as cheap as it was in 1971 at $35, and in 2000 at $300 almost. It's as cheap as that today in relation to U.S. money supplies. This chart shows here. So think about it in those terms. And I think that's the thought, Matt, that I would like to leave the viewers with.
No, look, we live in surreal times. We live with a surreal currency system, and gold is a very real, physical, scarce asset. And again, it is ultimately, we can't say this enough, we can pound our fist 1,000 times. Don't measure it against currencies that are losing their value by the second. Look at it as an insurance policy, as a real asset versus a paper asset whose credibility is falling by the week. So,
yes, absolutely. That's really what I think what we want to leave our viewers to think about, because now, as I mentioned, this graph that I just showed, this is the time now. It's unloved and undervalued. Buy your insurance, buy your protection now. Put a good part of your assets into that, and then you can sleep well at night and not worry about what's going to happen to the financial system.
Agreed.
So, that's good news. It's not bad news. Good news, and they should be taken as that. We're not prophets of gloom and doom. We just believe that protection is what you need right now.
Absolutely.
So shall we finish here for today, Matt?
Agreed. Let's end with that. It's a positive note on really not dramatic, but realistic problems in the world and realistic illusions. And let's end on a positive note, because there are solutions, and they're pretty commonsensical.
Okay. Thanks very much.
John. All right.
See you soon.
See you.